Good day, everyone, and thank you for joining us today in our podcast. Welcome to Friar Financial's Financial Forum. I am Marcus Fryer, certified financial planner, and I am here with.
Jeffrey Campbell, financial advisor, accredited in high wealth and sports and entertainment.
Great. So, if you are looking for clarity and confidence in your financial decisions, you are in the right place. Each of our episodes, we're going to break down last week's markets and markets in motion. We're going to unpack the headlines that matter in finance and focus, and we're going to simplify one key planning topic in our Wealth Wisdom workshop. And today's topic is going to be annuities. So that's one that I think a lot of our viewers are eager to hear. So let's dive in and make your money decisions clearer, smarter, and more intentional.
Yeah.
Now,
So just to
Jeffrey's
get
going to
us,
take it away talking about markets in motion and what happened with last week's markets.
yeah. So we got a bullish start, the start of the year as we dive into 2026, this fresh new year. I hope everybody had happy holidays as well. So stocks that surged across the board in a week packed with economic data, geopolitical developments, and fresh optimism for the rest of the year. So the S&P 500 was up 1.57%. To start this week, as well as the NASDAQ composite up 1.88%. The Dow Jones Industrial Average was up 2.32%, and the MSCI EAFE, basically the global developed markets, that was up 1.41%. So that gives us some important information about our data, and as well as that last one shows how the global market is working against our U.S. market. So um, diving in a little bit deeper, we had a nice little Santa rally, especially the Dow delivered on that. Some of the others lagged. So the Dow Industrial clinched the Santa Claus rally, rising up to 1.1% over the final 5 sessions of 2025 and the first 2 of 2026 to get us started. Now the S&P and the NASDAQ missed that mark, but momentum picked up midweek as AI-driven chip stocks reignited the investor enthusiasm. So AI playing a big part of what our market is today. And then kind of as we keep going, the Dow crossed into 49,000 for the first time, joining the S&P 500 and notching record closes and intraday highs. So that's a big part. That's record to see that. And then we got a notable rotation out of tech and the cyclicals, and defense followed. And then as investors responded to this administration's proposed $1.5 trillion defense budget for 2027, which exceeded the Pentagon's targets for that. And then broader economic reacceleration hopes favored industrials and value sectors. So also some important information as we kind of plan for the future with what this administration has going on at this current moment.
Yeah, I'm gonna hold you right there for a second, Jeffrey. Let me get up that slide on the tech because that's
Yeah.
really big. Um, and kind of go back to that because tech has been leading us for a while, and so as you can see from that slide there, the as Jeffrey mentioned, the quite a bit of tech outflows this last week in the last couple weeks. And we'll touch on that a little bit more in finance, but I definitely wanted to get that slide up to share that image regarding what was going on with tech.
Yep. Tech is big right now. It's a big part of what our market is today. So
Yep. Great, great, great. All right, going forward, keep going.
yeah. So as we kind of look at our labor market, and the Fed outlook for the year, December jobs report showed modest job gains. So some good news there. And then a slight decline in unemployment as well. So some good news in the labor market. Markets interpret this as the giving the Fed room to maneuver at a January meeting, potentially pausing or adjusting rate policy without derailing growth. So that's a big thing. They're looking to adjust some of this rate landscape that we're in right now without taking away from the growth that we experience as far as the labor market. So um, yeah, and then as markets is pulling up this slide, there are now 685K more unemployed persons than job openings in the U.S., excluding the 2020 COVID recession. This is the widest spread we've seen since 2017, as the labor market continues to cool out. So, all right, and then as we kind of go into our strategic takeaways um, from some of this information. Um, AI and chips, as Market just talked about, they're still driving with some midweek momentum. So that's important. We're still seeing the AI and tech pushing forward. The defense is benefiting from budget signals and rotation. The labor market, like I said, is cooling, but not alarming. And the Fed is flexible in this area. And then global equities right now, a lot of optimism and synchronized optimism across them. That's what that MSCI EAFE that I mentioned earlier is giving us an idea on. So, yeah, and like I said, just kind of to recap some of those things I just mentioned, the Dow Jones, we're in the strongest 1 month phase that we've seen. So that's up 3.28%, with 2.5% year to date in gains, fueled by sector rotation, defense spending optimism. Kind of going back to that, what does administration is increasing our defense budget. Um, Global developed markets, they're in DC, outperformed the US and DCs in that 1 month window. Like I said, that's showing that what I just mentioned, comparing us to our market to the global market, and they outperformed us a little bit in that 1 month window. And then, like I said, the Nasdaq has a slight year to date in 1.03%, but negative 1 month return as it faced tech outflow. So that's important stuff. It kind of gives you some ideas about long-term performance. The S&P 500 is dominating with a 5-year return of 94.73%, which is huge, reflecting broad-based strength and AI tailwinds. Like I said, still focused on tech and AI. The NASDAQ is having a strong 1 year, up 21.3%, and a strong 5-year, up 84% in return. So despite all the recent volatility we've had, we're seeing some stability in those big indexes, so which is important that we base our whole market off of. And then that same global equity market, the MSCI EAFE, with an impressive 1 year return of 33.2%, signaling resilience in our global markets, which is important. So
Good deal.
all
So
that,
I'm putting
yeah.
that
Go
chart
ahead,
back
Mark.
up, Jeffrey. So you could take so this is last week S&P 500. So just wanted to show people, and you can kind of go through with some of the data points, the kind of roller coaster the S&P 500 was on last week.
Yeah, a lot of ups and downs. I mean, you can kind of see it very clearly with the line graph that we had it started to increase a little bit slowly but surely. Then we had a nice little drop, and now we're back on that hill on the roller coaster, going up one more time. So, like I said, that's showing how up and down it's been this last week, but showing some stable growth overall. So, which is important.
Good deal. Now we'll pivot over to the bond market a little bit and
Hmm.
give you some info on the treasuries and what some of that strategy looks like.
Yep. So the 10-year Treasury snapshot, we're at a current yield of 4.18% as of January 9th, 2026. The 1 month change is flat, and the 3 month change is showing a slight uptick up to a little under 1%, so 0.97%. With a 1 year change, that's down right around 11%, or like 10 and a half, from to that's going down to almost 11% from 4.5%. So from 4.68%. So a little bit of change there, but that's kind of the 10-year snapshot of the treasury. And then what that basically shows us is that the 1 year decline in yields reflects easing inflation pressures and growing expectations for the Fed rate cuts in 2026. So we're seeing a little bit of that rate cuts already, but it's kind of growing expectations for more as we go into 2026. Um, then the flat 1 month yield suggests markets are holding in a pattern ahead of the Fed's January meeting, which is usual. And then bond investors appear cautiously optimistic, pricing in the soft landing scenario with stable long-term rates, um, which is good. So, like I said, those lower long-term yields that we're seeing, those support or supportive for equities and housing, which is important. And then that flat short-term movement signals the Fed policy is a little uncertain at this time. They're kind of staying in that holding pattern. And then as we look at the yield curve in total, we're watching for inversion of steepening as macro data involves. So that's kind of what we're looking for off that yield curve as we get more data regarding our economy at this moment. So that's kind of what the bond market is looking like at this time, Marcus.
All right. So that's our weekly wrap up and review for markets in motion. Give me just a little bit of economic data in terms of what's going on with the markets. So now we'll pivot to our next section, which is finance in focus. And in this section, we kind of take some of that information and kind of pull in some names and things of that nature that we've been seeing making some headline news. So let's take a look at that. All right. So let's see. As Jeffrey mentioned, rotation out of tech stocks. So where are people going? Of course. So what we're seeing is investors are allocating a lot of their capital from tech into cyclicals and defense, um, i.e., not defense in terms of the government and the military, but defensive defensive stocks, such as going into your safe spaces, such as consumer staples, consumer discretionary things that we know people have to buy day in and day out. Um, so why are we seeing that, or what's leading us to that? There have been 3 consecutive weeks of tech fund outflows. This is the first time since February of 2025 that we have seen that amount of tech outflows. Um, and it coincides again with record inflows in the money market funds. So that's kind of telling us people are getting a little bit cautious, a little uneasy about what's going on with the markets and the economy. Some of these tech valuations are coming in and normalizing now. So of course, whenever you see a run up in a sector, we saw it years ago in the telecom sector, that bubble burst. I think they're trying to make sure we don't have those type of bubble burst again. So some of these valuations are starting to become normal. And but some things like Google, Alphabet, as we call it, and Meta, they seem to be a little bit higher. And that's giving us a little bit of optimism in that space as well. What are some other AI and tech developments that we're seeing? OpenAI's ChatGPT checkout rollout is lagging, so they're a little bit behind on what they're trying to get out in terms of some of that OpenAI ChatGPT. Intel shares rose after the president and government invested, signaling political tailwinds for some of the domestic chip makers. So that's been one thing the government's talking about, investing in some of the public companies. So that backing is giving people some confidence. NVIDIA backed Lambda is seeking $350 million pre-IPO. So again, we're still seeing a lot of money flowing in, investment flowing into that tech space. And NVIDIA also appointed a new CMO, Chief Marketing Officer, in Allison Wagenfeld. So you should be seeing some new branding and enterprise expansion from NVIDIA. What else do we see here? Mergers and acquisition moves. Merck, potential $32 billion acquisition of Revolution Medicine. So that signals an aggressive expansion in their oncology and biotech sectors. Warner Brothers may reopen talks with Paramount again. And we have Antisports bid for Puma. So this is reflecting the Chinese interest in a global consumer brand. So Antisports is a Chinese brand looking to perhaps buy Puma. So interesting there. Other consumer and corporate headlines, we've got consumer electronic prices are set to rise due to memory chip shortages fueled by AI demand. So I guess the smartphones are going to get more expensive again.
Yeah, always good to hear.
Yeah, Johnson & Johnson dealing with the administration to lower drug prices and gain tariff exemptions may push competitors and shift pharma margins down. So pharma may not be our best place to be going, at least for the near future, as far as we can tell. Saks is near a 1.25 billion bankruptcy financing. Well, who'd have thought? Saks. Wow. And GM discloses a $7 billion hit from EV transition and China restructuring. So that's underscoring the cost of transformation. And finally, Qualcomm's new infotainment tech for Volkswagen highlights the auto tech convergence. So again, in summary, what are we kind of seeing here? Some of that market implications in that tech rotation. Pressures coming up on those mega tech cap technologies. Sector winners are becoming industrials, defense, and energy sectors. The risks we're seeing are in AI, semis, and communication services. That's where our risk lie going forward, at least for the foregoing week. AI infrastructure, continuing to see CapEx, so a lot of money going into AI, a lot of hiring going into AI. Who's winning in that sector? Of course, the chips are winning. Cloud-based services are winning. Um, Merger and acquisition activity. So we're seeing some consolidation of things. The winners in that space are pharma, mining, and media companies. Some of the risk, of course, are going to be regulatory, as the government going to let some of these things go through. Venezuela. What's going on with Venezuela? Market impact, long-term investment. The winners will be energy. We're talking about a lot of energy coming from Venezuela infrastructure. Of course, the risk becomes the political instability. We do not know what's going to go forward with who manages, who runs Venezuela, the regime, all those things. All those things have a global impact on markets and affect U.S. markets as well. All right, Jeffrey touched on housing, using housing. Mortgage rates. Mortgage rates dropped to 6.23%, lowest since 2022, down from an October 2023 peak of 8.09. Hopefully that gets the housing market going, but we still have a inventory
Hmm.
short. So prices are going to stay high until we get more inventory. People are still not wanting to put their houses on the market because they don't know where they can go. Debt and delinquency risk. Household debt service has hit a record high as a percentage of gross disposable income. Um, we're going to touch on that in a second. And matter of fact, we're going to stop for a second because Jeffrey was in the mortgage space. So, Jeffrey, let's talk about that for a second. We're just going to pause here. In that mortgage space, let's just take people through the theory of a mortgage, and specifically, what numbers were you qualifying people on, or does the mortgage industry qualify people on when they're qualifying them for their mortgages?
Yeah, so there's a couple things you're looking at that qualify for a mortgage. You're looking at your credit score as any type of debt obligation. You're always going to look at the credit score. Then we're looking at debt to income ratio, how much debt you already own compared to how much money you're bringing in. And those are probably the two biggest ones. And there's a couple other kind of side numbers people like to look at as far as what qualifies you, but those are probably the two biggest ones. Your overall debt to income ratio and then your credit score. So how you handle debt are the biggest ones as far as what qualify you for a mortgage.
Now, question: when you say income
Hmm.
and earning your application, are you
Hmm.
talking about gross income or
No,
net income?
net income.
Okay, because
Yeah, so net income.
yeah, so because you see a lot of people actually though, when they go and qualify, they're using their gross,
Yeah.
but that's not what they bring home. And so,
Nope. And that. Hmm.
so I think you're talking from your, right. So Jeffrey is talking from his perspective as a mortgage advisor.
Exactly. Exactly.
Now, but most times when you go to the bank, they talk to you from trying to qualify you for the most amount possible, and they're using your gross
Hmm.
income.
Yeah.
But we won't bring home our gross income. So be very intentional when you go to buy your home that you are qualifying yourself off of your net
Hmm.
income, not your gross
Cause that's
income.
what money you have to pay that mortgage with. That's what the money that's there
Exactly.
to pay it with. So.
Exactly.
Hmm.
So of course the bank is on one side and they're trying to make money, but you have to be
Hmm.
intentional on your house and how your household works. So I just wanted to
Exactly.
pause there because that's something that um everyone's not a mortgage advisor like Jeffrey
Hmm.
was. So
Yeah.
um,
Exactly.
it can get you in trouble really quick. All right. Moving on,
Hmm.
moving on. So let's get back to this labor market snapshot. So Jeffrey mentioned the labor market is cooling. Latest data reveals a subtle but significant shift. There are now 685,000 more unemployed persons than job openings. This
Okay.
is a reversal we have not seen since 2017 if we take out the COVID recession. So that's definitely going to spark up unemployment. So that's going to put the feds in a tricky position at the end of the month as to what they're
Yeah.
going to do. So we're going to have to keep an eye on that. So again, this marks a negative spread, meaning demand for labor is no longer outpacing supply. That's going to put
Mhm.
the employers back in control.
Mhm.
So now, when employees were able to run and jump from one company to another over a dollar, I think that's going to go away.
Yep.
Just because the employers are going to be back in control now. Um,
Mhm.
so hopefully, people can sit still a little bit, not have to make all these moves in the labor market.
Exactly.
All right. Well, that is going to wrap it up. Anything you got to add, Jeffrey? Anything I missed on finance in the news this week?
I don't think so. Like I said, I think those last 2 are extremely important because I think we're starting to see some shifts in the housing market. And then, like I said, when it comes to the labor market, it's going to put a lot of pressure on the Fed, which you said, and so that combined with some tension we don't usually see between the Fed and this administration, this last meeting of the month is going to be interesting. So,
Yeah, absolutely, absolutely. And those interest rates drive a lot of what happens in the market. So we'll be watching there. All right, so
exactly.
it's time for our segment on the Wealth Wisdom Workshop. Like I said, today we're going to talk about annuities, give you a little bit of pros and cons, how to position them, do they make sense, things of that nature. So, all right. So let's say you are offered a retirement investment that would rise in value if the stock market went up, but it will cushion your losses if the market went down. And this investment could eventually guarantee an income stream for the rest of your life. Chances are you're probably going to take a look at it. And that's what we're talking about today, annuities. So this it helps explain why nervous savers have recently latched onto investment linked annuities in particular. And it's a alphabet soup of lineup, as we call them. You hear the words FIAs, RILAs, and VAs. So fixed
Mhm.
index annuities, um, excuse me, market linked annuities or the RILAs and variable annuities. So we're gonna go through all of these. Now, keyword I'm going to use here: sales of these products in the U.S. grew 29% in 2024 and another 6% in the first 9 months of 2025. They are now account for 57% of all annuity sales. So these three products count for about over half of annuity sales. Um, but these aren't for everybody. So keep in mind there's some things we got to pay attention to. Oftentimes the costs are hard to decipher and can be unexpectedly high. And we're going to get into those costs. The terms can easily be confused and misunderstood. So you really got to understand what you are purchasing. And finally, they can tie up your money for years. Once that money goes in, it is hard to get it out. We'll kind of talk through that piece. And finally, there are big sales commissions that financial professionals receive. And so oftentimes they're not pitched appropriately. So, one thing we'll also talk about is now that there are fee only annuities that avoid some of these big commissions that financial professionals receive, and they put you in a much better position. So, we'll talk about how fee only annuities works versus your traditional commission based annuity that somebody, again, I like to use the word, is selling to you as well. So, from there, I'm going to turn it over to Jeffrey. So, he's going to kind of give you the nuts and bolts of how an annuity actually works.
Yeah. So, generally speaking, annuities are basically an insurance product that create a lifelong income stream. Plain vanilla income annuities work mostly like this. In return for a sum of money, an insurer will pay you a certain amount on a regular basis, usually monthly for the rest of your life. The guaranteed income is based chiefly on current interest rates and your age and gender. So those are the kind of the three things that they're based off of. The movement of the stock market is irrelevant when it comes to these. Um, but then when we go into but investment linked annuities are different. So we talked about the plain one. Now we go into the investment linked ones. Both their value and their income stream is possible to draw um, from them. Can be affected by the stock market's performance, and this can be confusing because even though their name applies yearly income, they're usually used for more than just creating a stream of payments. You can use one to build retirement savings over many years by capturing some of the stock market's growth and decide later if you want to turn the annuity into regular income, take non-annuitized withdrawals, or leave your investments for heirs. So even more confusing, most people who do create an income stream from these annuities don't do so by turning them into plain vanilla annuities. Instead, at the outset, they pay extra for an insurance rider that guarantees a minimum income stream later, and one that may be increased by the stock market's performance. And so we'll kind of dive into each three of those basic flavors are annuities, like that alphabet soup that Marcus mentioned earlier. So to start, we got the fixed indexed annuities, FIAs. So typically these promise that the dollar amount of your investment won't go down. In return for a percentage cap of how much it can rise per year, for example, let's say you can buy a $10,000 FIA with a 10% cap and a value linked to the performance of the S&P 500, a basket of 500 large companies stocks trading in the U.S. And you heard us mention that a whole bunch of times in our market update. If the S&P 500 falls in value, you'll still have $10,000 at the end of the year. If it rises anywhere between 0 to 10%, that 10% cap I mentioned, your investment will rise the same amount. But now that's where it gets tricky. If it goes over that 10%, you won't get any of those additional benefits. So in 2024, the S&P rose 23.3%. So for that $10,000 FIA, it would not have gained $2,330, but only $1,000 because of that 10% cap. And then we're going to register index linked annuities, RILAs. Like FIAs, these link to stock indexes, but they generally have higher limits on gains. In return, you face the possibility of losses, though they generally are limited in the form of what's known as a buffer. If you had a RILA with a 20% buffer, for example, your annuity wouldn't fall in value as long as the linked index fell no more than 20%. But any losses beyond that would be yours. So if the index fell to 25%, the value of your investments of your RILA would be down 5%. So once you turn on your income stream, a negative return won't impact your guaranteed minimum income. And then we go on to variable annuities, the VAs. For these annuities, you have a mutual fund to invest in. Like any mutual fund, those funds you own in a VA can rise and fall in value. You don't have the downside protection for the money you invest. But if you buy income rider, you do get the protection for the future income stream, which is important once you're ready to turn on the annuities income spigot. So like a faucet. Your guaranteed minimum income, lifelong minimum income would be based primarily on your original investment, your age, and your interest rates. As long as your withdrawals don't exceed the minimum, your monthly income won't fall below that amount and may even rise if your investments grow in value. And then I'll kind of swing about the markets and it'll talk about what happens with an annuity and your income stream and some of the benefits and downsides of it.
Yeah, great. So that, as Jeffrey just pointed out, it's kind of the nuts and bolts. There's a lot deeper dive on those annuities. We try to give you the most simple version we could of how they work because they can be quite
Exactly.
complicated. And I can't tell you how many people we have taken out of annuities. But anyway, so think of annuities as a lot of times a more proper way to place them is as a replacement for your bonds. You'll hear that in your portfolio. Because if you put them in there to replace your bonds, they kind of give you a floor, right? Because the bond prices are still going up and down. So the annuities but here's the problem with annuities. They typically underperform stocks because of their caps that Jeffrey just mentioned. And he gave you that example
Exactly.
where, they put that 10% cap on you in exchange for protecting your downside because they're going to keep everything above that cap. So although they can bring you a little bit of peace of mind, we're also giving up quite a bit. And we'll get to this, but normally speaking, when we model an annuity in our financial planning software, trying to model for longevity risk and making sure a client won't outlive their money, and enjoy the life they want to live, most times our probability of success actually decreases. And that's because we're giving up what we call that right side of the tail. The left side of a tail is the risk side, right? And our job as advisors is to manage the left side of the tail on and i.e. mimic what the insurance company is doing. They're taking the risk for you, but they're cutting you off on that right side. And when you start to give up 4, 5, 6% annually on the right side in years that the market is doing well, that's a significant amount of income that could be rising in the portfolio. Um, so, all in all, so let's kind of go through that. So, as you talk about, here's one other key thing. So we talked about the cap, but there's another thing that you miss out because all right, so let's make sure we understand. When they credit your account, it's what they usually call something they call point to point, right? So let's just assume you purchased a annuity January 13th of 2025. So today is January 13th, 2026. So they're going to take a look back. How did the market do from 2025 to 2026? That credit comes in. You're capped at 10%. If you did six, you get six. If you did eight, you get eight. If you did 12, you get 10, right? So now we can see how they're keeping that difference. But here's another thing that you're losing. You're losing dividends. You don't get
Mhm.
any of the dividends. And since 1926, dividends have amounted to more than 30% of the total return of the S&P 500.
Oh, wow.
So not only the market performance, but the dividends go missing. That's why if we do our jobs properly, we can not only mimic the annuity, but beat it. And that's why that probability
Mhm.
of success goes down in our financial plans because that planning software is like, okay, yeah, you're capped. This is what you're going to get. But if we were investing it and we got an average return of 6, 7, percent, we're going to beat that. We're going to
Mhm.
beat that. Um, and so that's the part that kind of hurts the investor and the retiree, and something that a pre-retiree needs to know as they're going into retirement. So let's take a quick look at again as we're talking with pre-retirees, retirees heading into retirement. I just want to show you all kind of how we actually look at that in terms of the income that you need. So I'm gonna share my screen here and hopefully you can see. Okay. So there are really three levels of income we're trying to create for a person. First, you need your minimum guaranteed income. As you can see on the screen, this covers your basic mandatory expenses in retirement using reliable and stable financial sources, ensuring essentials are met. We'll talk about those in a second. Next layer, conservative flexible income. These are funds for your non essential needs, but desired items. This level needs to offer adaptability to changing situations without compromising your financial security. So, a little bit more aggressive than the first bucket in order to keep up with inflation, things of that nature, but not really very aggressive because you are in retirement and need some sort of guaranteed income. And then the third bucket is just that desired extra money bucket for your fun money, travel, hobby, life's pleasures, golf, whatever that may be. We need that fun bucket. So let's go back to guaranteed bucket number one to pay for your bills. They could be your mortgage, your utility bills, water, internet, things of that nature. Well, our first kind of guarantee, and we're going to keep it as a guarantee for right now, is Social Security. And Social Security
Mhm.
actually rises, so it fights inflation for you as well. So that is your first level of guaranteed income. Second level of guaranteed income is, while it's fallen out of favor quite a bit, are pensions. There are still pensions around, especially for federal and
Mhm.
state employees. They still have pensions. Some of your
Mhm.
still larger companies are offering pensions. So now we've got
Yeah.
two sources of guaranteed income. So it befuddles me when I see a client come and they've got an annuity and they already have a pension. And I'm like, oh, yeah, somebody sold that to you because you already have guaranteed income. You don't
Mhm.
need a guaranteed income. You're giving up too much. You're giving up too much in the market, especially if you're
And that's why
working
you got
for.
to be careful with salespersons.
Exactly. Yeah. Um, Yeah, that's where we gotta understand, and we'll have a whole nother session on fee only versus commission people and the benefits and downside and all that kind of stuff. Um, but yeah, and then you start to see these exorbitant fees in them, income riders, like the one I saw, they had an income rider. I was like, the lady already has two guaranteed sources of income. Why would you put another income rider on top of that? And in addition, now her money is tied up because she can't get it because of the surrender fees and the surrender charges.
Hmm.
And in this particular case, when they put the income rider on her and she needed some money, of course they go, oh, well, you have an income rider, so you can only get $5,500. So basically, we had to take her out of the annuity because she wanted to take some money and invest in some real estate. So we had to take her out of the annuity. Thankfully, she was towards the end of the annuity, so she had very little surrender fees. Got her out of the annuity, freed up some money, paid the taxes on it. Now she's invested in real estate, which is bringing her a much better return. So they tied her hands. They tied her hands. So these are the things that you've got to pay attention to and make sure that someone is explaining to you the pros and the cons of these annuities or any product for that matter. If you don't have a full answer, then just take your time. Just make sure you're taking your time. Um, One other thing we want to talk about is in the annuities and in some of these articles, you'll see people make a comparison to go, hey, we're just going to you could just go into an index fund because the index funds are cheaper. Well, yeah, the index funds are nice, but there are some issues with index funds as well. And we're not going to give away next week's segment. But since we talk about this is a nice segue into next week's segment, which will be on index funds. Um, and so yeah, so next week our wealth management corner is going to talk about index funds. And we're going to give you the pros and cons of those. Are they cheap and expensive? Yes. Do they have some drawbacks? Yes, they do. And we are looking forward to talking about those. Jeffrey, episode 1 is a wrap. I'm so excited. We have finally got this going.
Hmm.
Anything thing you want to add to wrap up this first session?
Not much, man. I'm excited as well. I'm ready to. I hope everybody stays tuned for some of the future topics as we dive in to give you more market updates and kind of some more wisdom in this financial game. So it's exciting stuff.
Absolutely. So you all please feel free to write us because we don't want to talk about what we want to talk about. We want to talk about
Exactly.
what you guys need us to talk about. So please comment on social media, email us directly. Jeffrey is J Campbell, CAMPBELL at FryarFinancial.com. M
Hmm.
Fryer at FryarFinancial.com. Definitely email us and we'll be glad to cover a topic that you want us to cover and delve down into it. So again, thanks for joining us today on today's episode of Friar Financial's Financial Forum. I hope you're leaving with more clarity, more confidence, and a deeper sense of purpose in your financial journey. If you found today's conversation helpful, be sure to follow the page, share it with someone who might benefit, and leave us a review. We'd be glad to hear from you. It helps more people discover the clarity they've been looking for. So until next time, we will see you on Friar Financial's Forum. Take care, everyone, and we'll see you next week.